Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google Map for hardworking Canadians seeking financial freedom. And one of the means to become financially free is to use debt to invest in real estate. And a lot of our clients these days are using private lending money to essentially help them close the properties because there could be gaps and there's gaps in terms of appraised values versus what they pay or agree to pay. And a lot of our clients and even lawyers that we work with are telling us about all these last minute situations that bring us to today's special guest that I have, Jesse from Calvert Mortgage. And it's actually my honor, first time ever to interview someone, and he's willing to let me interview him on Zoom because it's my first time, so I don't know how it's going to be like. But before I get Jesse on our YouTube video, I just want to make sure that everyone subscribe to my channel, and also make sure that everyone get a chance to give us a thumbs up if you find this video useful. With that, welcome Jesse.
Thanks, Cherry, and thanks to all your listeners and viewers for joining us. I'm humbled to be the first time Zoom interview, and I know it'll be great.
Yes, it's awesome.
Yeah, so Jesse Bobrowski from Calvert Mortgage Investment Corporation. I am a partner with the company and vice president of business development. I am the father to two amazing children and husband to one amazing wife. Work for a really great team of mortgage providers here at Calvert, and our aim is to provide an effortless experience for the personal and financial success of others.
Well, as my understanding, correct me if I'm wrong, Calvert is a little bit different because I have a lot of clients who also do mortgage investing, do private lending, and they do it on their own money, using their own money, and they may arrange it through a mortgage broker and lend it to someone who's in need of the money. How's Calvert Mortgage different from?
Yeah, so we're very different than the example that you just explained. We are a mortgage investment corporation. So we're essentially we are a fund of mortgages.
Okay.
So whereas some of your clients are doing one-off real estate lending opportunities, we're professionally managing the fund, professionally managing with underwriters, a finance team. We have uniquenesses like we have a big bank facility, a $200 million facility that we can draw from and leverage up our returns to our shareholders. And our focus is to lend on short-term real estate opportunities in major urban centers. We've chosen that as our goal because a lot of the banks and even our competition doesn't want to lend short-term. You know, there's a big cost to do the underwriting, do your due diligence, get your money out only to have it come back quickly. We love it because of that niche. And 75% of what we do, Cherry, is supporting real estate investors who buy, renovate, and sell. So flippers, or real estate investors who buy, renovate, rent, and refinance. So people who build their rental portfolio through the BRRRR strategy. So that's predominantly the borrowers that we service. And we've built unique product features to best serve those real estate investors. So essentially, we are a pool of individual alternative mortgages. Currently, we have pooled $320 million of mortgages. Again, predominantly residential in major urban centers. We have about 920 loans on our books right now, with an average loan to value of 58%. So for every $58 million we have lent out, we have $100 million of mortgage security. So
I can't help. I can't help but ask because like you mentioned, your primary target customer is the people who are doing BRRRR strategy or flips in major urban center. I don't know if this is a question that's not supposed to be asked, but I'm going to ask it. I know, Jesse, you have an answer for it. What are the market right now? Because it doesn't seem like the market is that easy.
Yeah, the market is definitely not as easy as it was 7 months ago, particularly in Ontario. So we have right now, we're lending in Alberta and Ontario.
Mm.
We have today about 55% of our money in Alberta. The bulk
Yep.
of that is in Calgary and Edmonton. And
Yep.
then the other 45% is in Ontario. So the market is there's a lot of downward pressure in Ontario.
Mm-hmm.
So for flippers, particularly ones who bought in December, January, February, or March, and that are trying to sell today, they're at a real disadvantage because of how quickly the market went down.
Mm-hmm.
Um, in saying that, this is something that we had anticipated as a fund.
Oh.
With what we saw in the rise in Ontario, we knew a lot of that was artificial due to very cheap capital.
Mm-hmm.
So we were underwriting in the mindset that there could be and there would likely be a
Mm-hmm.
large correction. So we're seeing that today. A lot of our borrowers, they basically all of our borrowers, Cherry, make their money on buying right. So you don't make your money by doing the renovations better than the next guy. Yeah, maybe
Mm.
you could save 1, 2, 3, 4, 5,000, but you make your money by buying right and buying under market value. And usually, in order to do that, you're buying private sales, you're buying houses that are dilapidated, have significant deferred maintenance, where the general market is not attracted to that type of product. So while it's not as easy today for those people in Ontario that bought at those times, we're still seeing a lot of opportunities, especially today where our sharp money, our sharp buyers are finding really good deals. Because 7 months ago and beyond, what a
Mm-hmm.
lot of our more sophisticated borrowers saw was that there were no good opportunities. Even the private sales, because the market psychology, it was such a seller's market that in order to buy right, they needed to factor in appreciation. And to us, when you're doing that, you're speculating. And
Mm-hmm.
we
Mm-hmm.
won't lend to those borrowers that are speculating. We need to see the real numbers, run our analysis, and let the numbers prove out that when you're done renovating, you're going to be profitable. So, long story short, yes, in Ontario, there are some headwinds. Yes, it's a bit more difficult of a market today than it was, but I would say the buyers buying today have a high likelihood of success versus especially the buyers that bought 6, 7, 8, 9, 10 months ago. So those are the mortgages we're watching more carefully in our book today.
So, like in other words, you guys have a very, I would say, more scrutinized approach in terms of when you land out, when you find your primary customers. It's not like you're going to land to everybody.
Correct. Yeah, we're fortunate. We've been doing this for 40 years. We've lent literally billions of dollars on tens of thousands, almost tens of thousands, thousands of mortgages. Um, so we have a lot of really good data, and we've built in a
Mm.
lot of really good business practices through learning what happens, especially through learning what happens in the downside. Outside of 3 years ago, all of our money was lent in Alberta, which has really big real estate cycles. So we've developed underwriting practices around protecting our downside risk. Our goal as a fund is firstly preserving capital, secondly
Mm-hmm.
providing a better than average risk adjusted return to our shareholders. And we've been fortunate through our 40 years to do that. Our average return to shareholders over that time has been 13%. Over the last
Wow.
10, over the last 10, we've been 9.7. This year, we're projecting to return in and around 11%. So yeah, we scrutinize our loans very carefully. And particularly with our real estate investors, the way we scrutinize them is we analyze the borrower. Do
Mm-hmm.
you have the capacity and the capability to execute on your plans? Do you have the money? Do you have the network? Do you have the trades experience? Do you know what you're doing? And then are you buying right? Is the property you're buying going to be profitable for you? Then
Mm-hmm.
we look at what your budget's going to be. We estimate the after repaired value, back out all the costs, and look at is there real profit in this for the client? And by real profit, we don't want to see somebody buying for 600 grand, putting $60,000 into it and maybe making 20,000. That's just too thin of margin for them. So for an example like that, we'd want to see at least 40,000. So that's kind of our underwriting parameters and how we go about things for 75% of our business, which is real estate investors. And then for the other 25% will be things like equity takeout, debt consolidation, purchases for new Canadians. And again, we have really stringent underwriting criteria. We have an excellent underwriting policy. And we continuously are looking for the feedback loops. And usually, unfortunately, the feedback loops are when you lose money. What happened? What needs to be tweaked? How do we make our business better for the future? So it's quite different than you lending your own money because of how much data analysis and rigor goes into our underwriting process, and also how much experience we have. Again, I'm within our executive team. I'm the young buck, being in this industry for 16 years. Our founder Everett, who's founded us over 40 years ago, still the chairman of our board, been doing it for over 40 years. His two sons, my partners, Dean and Dale, both over 20 years. So we have just an incredible amount of experience doing this, and we've built a lot of our policy, procedure, and process off of that.
So, okay, now I understand how you guys are different and working for your shareholder, but how does it work if we were to approach you and borrow money? How are you guys different from the A lenders?
Yeah, so for borrowing money, there's a number of things that we differ in. Firstly, how quickly we can fund. So we've built a business where we can literally have the lawyer instructed within 24 hours. So you can come to me now with a loan, provided you have all the documentation. We can underwrite it and appraise it. We have a team of professional appraisers who work for us, only us. They're employed by Calvert, that do the appraisals at no cost to the borrower, which expedites the process. Any other lender is going to need 3, 4, 5 days for the appraisal to come in. We do that same day. So we can fund within 24 hours. That's a big uniqueness. Another big uniqueness is that we love short term. Like your bank, if you're a flipper, you might be able to do 1, 2, 3, 4 deals with the bank before they realize, whoa, Cherry, you're paying me out every 6 months. We're not making money off you. You're cut off. We love that business. We also love, what the banks don't, is buying houses in poor condition. Even if you are fortunate enough as a real estate investor to get a bank line of credit where they're going to look to support you, a lot of the times when you're buying a profitable house, it's going to be in such poor condition that it doesn't adhere to bank standards. Whereas we just see opportunity with those properties. Sorry to cut you off. Yeah, no worries.
Yeah, like it's the same. I think I had a personal experience in the past that we bought this house literally, like you mentioned, directly from the seller, and there was electrical issue, there is like flood issue, and the bank was reluctant after looking at the appraisal report, because the appraiser report everything there, everything they saw. Actually, they also look at the home inspection report as well. So they look at everything, and it would, like, we didn't know you back then. It would have been a perfect match with you guys to close it with that property and then refinance it through a lender after it's being renovated.
Yeah, a ton of our borrowers use us in those ways, like short term, whether it's through the renovation to sell or renovation to refinance. And then usually, you improve the value to an extent where you're literally pulling some of your renovation costs back out. Another uniqueness, Cherry, that we have, particularly for real estate investors, is we will lend with very little down. In Ontario, we'll lend with as little as $20,000 down.
Okay, I can't help because I'm a lumber person in a way.
Yeah.
Like you just mentioned that your portfolio is about 50% loan to value, and then and then you're saying that you're lending with as little as $20,000 down. How does it add up? I'm sorry.
Right. Yeah, no, this is
Putting
good.
you
This
on
is
the
great.
spot. Yeah.
We love it because these are the same conversations we get to have with our borrowers, our shareholders, our bankers, a lot of our trusted service providers. So the way that it works is when buying right, we're going to support it with as little as $20,000 down, provided you can execute. So execution is you're going to show us your cash to renovate. You're going to show us your ability to renovate. We're going to value the property after repaired, and they're going to go through the process and complete the property. So we are basing that loan to value off of the completed project. And in our history, there certainly, you're probably wondering now, Jesse, there's risk that they don't complete the project.
Yeah,
absolutely.
exactly.
Absolutely there is. We've seen about 2% of our borrowers not complete the project.
Only 2%?
Yeah. And because of when they're buying right and they have the plan, there's typically always profit in them. So they're always, even if profit is deteriorating, like in today's market, it still makes sense for them to complete the project, list it, sell it, and move on. And maybe there's not profit, but there's still money on your exit usually. So maybe you're losing money, but you're still going to get your renovation costs back or your down payment back. There's some tangible gain financially for you to finish. The 2% where we have people fail to execute, 90% of those times is a life issue happened. Something traumatic, substance abuse, that type of thing, where they get sidetracked and they completely abandon the work. But even when that happens, Jerry, because we cater to this market, all of our clients are looking for a great purchase. So when it happens, we look at the property and we say, okay, here's what it's worth today. And in all likelihood, we can go to the market and it will sell to make us whole.
So let me just rephrase that. So if I were to go to you guys and you lend it to me, I only put $20,000 in and I wasn't able to, for whatever reason, I wasn't able to complete the renovation. And so the house is like, whatever, half completed, which partially you see today. Yeah, quite common today in today's market, in Ontario anyway.
Yes.
So I'm unable to fulfill my obligation to you guys. So what's the worst case scenario for a borrower? You're saying that you will take over the property?
Well, yeah. So your worst case scenario is to sell the property. Whether you sell it yourself or we sell it through power of sale. And then in the bulk of those worst case scenarios, Calvert's going to get made full. And there's probably a little bit left in it for you, the borrower.
Okay.
Your worst case is where Calvert loses money. And then we would we would hold the obligation of the loss against you. So you would have a deemed loss, and we would be able to collect on that over time.
Yeah, for sure. So it's just like a typical lender that if you can recover everything, then you'll go after other assets. That's just how it is in regular borrowing world.
Yeah, so that's our borrower's worst case scenario. And through that scenario, as long as the borrower's working with us, we'll work with them, right? Like if they're communicating, we'll estimate the value, we'll let them list, because there's no sense in us listing it through power of sale if you want to list the property for market value.
Yeah.
It's where you fight us and we can't agree on a mutually beneficial solution where we have to involve the legal process, but we always try to work with our borrowers.
So I guess one of the example that I got personally or through my client situation is that she holds the second mortgage, and she didn't know that the borrower default the A lender mortgage, the first mortgage. And she didn't even recognize how much the big banks are charging when you default their mortgage. So the fees keep accumulating. And at the end, I think there is almost no equity left in the house because of how much the A lender is charging when they default. What are the fees like when someone default your mortgage?
So in your friend's instance, that's terrible to hear, firstly.
Yeah.
But it is part of the risk of lending. Like what we're seeing in Ontario is we believe that a lot of people are discounting risk. Your market has gone up for 20 years. And through that, a lot of psychology builds where you can believe that that's only going to continue. And because of that, you see we're seeing a lot of these really unfortunate scenarios. For us, all the money that we have in Ontario is in first mortgages. So
cool.
Yeah. We about right now 97% of our book is firsts. We don't do many seconds, for many reasons. But yeah. So anyhow, going back to your friend's scenario, when I just went through this where we have went through power of sale and there's a borrower behind us. That borrower is really best option, I think, as long as they can afford it, is to pay out that first mortgage lender. And they have that option to assume that mortgage.
Yeah.
So what we did for the lender behind us is we didn't charge a bunch of fees. We just said, if you make us whole, being all the interest that's out, any legal fees, any other true expenses that we've had, you will release the mortgage without charging. Like, we have the ability to charge a default fee. We essentially have the ability within our standard mortgage terms to charge an extra $20,000 to $30,000 on top of what's outstanding. But we don't see the need to do that. If you make us whole and you save my time for going through the process, I'm grateful. I'll waive all the fees and you can simply pay me out. But your friend has to have the means to be able to do that. So it's important for your listeners that when thinking of going in a second mortgage position, your worst case scenario is you need to take a look at that first. Do you have the capacity to do it? If you don't, you should rethink your second mortgage.
Oh, 100%. Fortunately for her, she turned it into like something $100,000 to $140,000 worth of profit subsequently in that particular case. It's just that it's interesting for me to learn that, hey, a lender, if you are not careful with your payment, or the borrower is not careful with the A lender payment, they could easily be charged a huge amount of fees without you knowing. Okay, so now that I know Calvert is super flexible, I need to know how much you guys are charging. I'm a number person, sort of. So what are the rates in today's environment that you're charging?
So I'm going to give you averages. Well, no, I'll give you kind of low and high, and then I'll give you average.
Yeah, sure.
So right now we charge for every loan that we do, we charge a rate and a fee.
Okay.
That rate in today's market has gone up. We've increased our rates since the beginning of this quantitative tightening. So today, since March to today, the Bank of Canada has increased 3.5%. We've increased on average half of that, 1.75. So today, our least expensive money is 9.24. Our most expensive money is 16.9. Most of the borrowers use our cheapest money, so they de-risk us by putting more money down and that type of thing. Our average interest rate today is 10.1%. Our fees, the least expensive fee we have is 1%. The most is 2.5%. Our average fee is 1.12 today.
What's the difference between the 1% versus 2.5%?
Depending on the term of the mortgage, depending on the risk, the shorter the term, the less fee we can charge, because when you annualize that fee, we look at the total return, not just we look at the holistic return, not just the return on inception. And we recycle our money. So we're running modeling that keeps that in mind, right? Like, when we're getting paid out on average, our whole book, 10% a month, that fee generation really compounds itself. So anyhow, the fee is it's all related to risk, and it's all related to time. So that's the difference between fee and rate.
Okay, so do you guys register your mortgage against the personal credit report?
We don't. And because we're such short-term lenders, we've never really been asked to. Like, I could see it. Let's say we were doing a mortgage that was likely to be on our books for 2 years. And the reason we were doing the mortgage was because the client's credit was poor. That client would want us to register our mortgage with their credit bureau so that they can increase their score. But because we're lending so short term and it's such a niche product, we haven't seen the need to register against credit bureau.
But then you still register a lien against, obviously, the property. You just don't register necessarily with the credit bureau.
Oh yeah, anytime we lend our money, we're mandated to have a registered mortgage on title. We just don't register against credit bureau. We would register if we had a claim for a loss, we would register that against credit bureau. Absolutely.
Okay. So this is a follow-up question. How would you know someone borrow money? How would you know if you don't register against credit bureau? How would other people know that they have this obligation? Let's say I have a property A and I borrow from you guys 500,000 is worth $1 million. So my credit report doesn't really show that and they're not really, I'm not borrowing against this particular property anymore, but I could easily say that, hey, I have no mortgage on this particular property, unless they do a search on that property. For that particular property, I could easily say, hey, like I own this property outright. Because typically, if I'm borrowing to buy another property, they would not check my other properties report, right? The land registry.
I would disagree. A prudent lender would check every single title.
So, yeah?
When we're lending, and we're lending to real estate investors who own a ton of properties.
So you check every single one.
Every single title, and we get a mortgage balance statement on every single mortgage.
Oh, okay.
So you can't hide. It costs us $35 to pull title in Ontario. It costs us $5 in Alberta, but that $35 is absolutely worth the investment every time.
So did you discover stuff from that $35 or $5, depending on where you land?
Always. Like it can even save us. Like, for instance, sometimes borrowers come to us and say, "Oh, I'm gonna let you blanket this property, and there's a first mortgage with TD for 200 grand, and it's worth $1 million." And then we pull it and we say, "No, your first mortgage with TD is 700,000 because you have a HELOC. That's a mortgage." And right away, that's just saved my underwriters an hour and a half of their time and my admin. So now I've just, and that time is expensive. Now I've spent $35 to save the company upwards of $500 in man hours just by finding that one tweak. So that's a quick example of how it has saved us time and money. Another example would be, similar to what you're saying, where they say they have lesser debt load than they really do. And then when we run their entire debt load and serviceability, it shows that, whoa, these guys are not viable. They're losing money. We're not participating. So this is a good reason why I like the people that are lending their own money, Cherry, individuals, they should really consider a fund, like whether it be Calvert or another professionally managed fund, because you can run into a lot of issues. We deal with some investors who have, let's say they have $20 million and they have $5 million with us, and they just love deals. So they have $5 million of their own that they're putting out to the market, but they have infrastructure, they have lawyers, they have hired people that are helping them with this. And I think in order to properly underwrite risk, you need to have that level of sophistication.
So Calvert actually takes investors.
Yeah, we're made up of shareholders, absolutely. So,
cool.
Our book of $330 million today, 130 million is bank debt, 200 mil is shareholders. The shareholders that we permit to access our fund are accredited investors, so individuals who either earn $200,000 a year or have more than $1 million net financial assets. we like to be as closely held as possible. We really like to know who our shareholders are and have really good relationships with them. So there are 10 shareholders that make up right now 55% of that 200 million. And our goal is to continue to grow through that channel. So those would be family offices, investment fund managers who their fund invests in us. Yes, we have the odd entrepreneur, and we love dealing with those people. But we look at it where the higher level of sophistication our investors are, the better the questions they're asking us, the better the checks and balances on us, the more we're challenging ourselves to raise the bar of risk, of how we're managing the fund, of how we're managing our business. So yes, we do have we do have individual investors.
Just very few. What's the minimum to investment?
We don't have a minimum because we set the standard high at 200,000 income or $1 million net financial. Like we have some people, for instance, friends of mine who are young professionals, earning really good incomes, and they're investing $30,000 a year through their RRSP with us. So they're maxing out their RRSP and investing it and watching that compound. And you're a numbers person, as we know, yep. $30,000 compounded at, let's even discount our return to 8% over 20 years can be something really substantial, well into the millions.
Yeah, absolutely. Although I don't know if CA stands for can't add, so I cannot do the math that you just did in my head. So I need to pull out my calculator to do the math, and I can't confirm it right now. So, but that's great information. I really appreciate this call. And if any of our audience want to reach out to you, how do they do that?
We have a great website. Just Google Calvert Mortgage Investment Corporation. It's geared towards real estate investors, education. This webinar will be on there one day. And it's all about empowering our borrowers to make really good financial decisions so that they can be more profitable. That's what you'll find on the website. Instagram at Calvert Home Mortgage. Again, all the content is empowering investors to make better decisions, to be more profitable. If you're interested in investing in us, we don't have much information on the internet, really none at all. So you'd have to reach out to me. We could share our audited financial statements and give you our investor deck and show you our returns. But that you'd have to reach out to me, and it's Jesse at chmic.ca. But you can also reach out, DMing in our Instagram, or just you'll see our contact information there on our website.
Don't worry, your contact information will be in our description below, so that's not going to be a problem. So you guys can find their website and everything. Yes, thank you so much again for coming on to our YouTube channel, and really appreciate it. It was very informational. Like it's a lot of knowledge. I already know what my title of this whole YouTube video and my blog post would be.
Awesome.
Yeah. Thank you so much. For those of you who find our video useful, make sure you give us a thumbs up. If you have questions, make sure that you comment in the section below and hit the subscribe button if you want to stay on top of the latest tax tip. Until next time, thank you for watching.